Your car insurance renewal just arrived. You haven't had an accident, no tickets. Your car is a year older than last time, and somehow your premium went up $400. You're not alone. According to ValuePenguin's 2025 data, auto insurers raised rates by an average of 16.5% in 2024. For 2025, we're seeing another 7.5% average increase. Smaller, but still climbing. The average American now pays $2,101 per year for full coverage, a record high. But here's what the insurance companies don't want you to know. While you can't technically negotiate their approved rates, you can absolutely work the system to pay less. Retention departments exist for a reason. Discounts go unclaimed every day, and sometimes the best move is walking away entirely. Today I'm giving you the exact scripts, the specific tactics, and the decision framework that separates people who just accept rate hikes from people who consistently pay less than they should. Let's get strategic. Before we talk tactics, let's understand what we're dealing with. This isn't personal, it's systemic. According to the Bureau of Labor Statistics, motor vehicle insurance has been one of the biggest contributors to inflation in 2025. Multiple factors are driving costs up. Repair costs are exploding. Modern vehicles are technology platforms on wheels. The sensors, cameras, and computers that enable safety features also make repairs dramatically more expensive. A simple bumper that used to cost a few $100s to fix now involves radar sensors and calibration procedures that can cost thousands. Parts are more expensive too. About 60% of replacement car parts are imported, and tariff policies have added costs throughout the supply chain. Beyond repairs, rising medical costs and weather-related claims are also pushing premiums higher industry-wide. Company-specific factors. Not all insurers are raising rates equally. American Family is hiking rates an average of 16% in 2025, the most among major insurers. Meanwhile, USAA is only increasing about 2.6%. GEICO and Progressive are somewhere in between with modest increases. Understanding this landscape matters because it informs your strategy. If your company is among those raising rates aggressively, switching might make more sense than negotiating. Here's the reality about car insurance: negotiation. You cannot negotiate the base rate. State insurance departments regulate pricing formulas, and once approved, agents can't simply lower them on a phone call. But, and this is critical, you can access discounts you're not getting. Restructure your coverage to reduce costs, and leverage your value as a customer to receive special consideration. The retention department. When you called your insurance company about a rate increase, the first-level customer service representative has limited authority. The retention department has more flexibility. Here's how to get there. Script 1, getting to retention. Hi, I'm calling about my recent renewal notice. I've been a customer for X years. I have a clean driving record, and I was surprised to see an X% increase. I'd like to speak with someone in the retention department about my options. That's it. Be polite, but direct. The word retention signals that you're considering leaving, which is exactly what triggers escalation to someone with authority. Script 2, once connected. Thanks for taking my call. I've been with company for X years with no claims. My renewal shows a significant increase, and frankly, I've received quotes from competitors that are lower for the same coverage. I'd prefer to stay with you, but I need to understand what options exist to make this work. Key elements here. You've established your value, loyalty, clean record. You've created urgency, you have other options, and you've expressed a preference to stay, which is easier for them than acquiring a new customer. What to ask for. First, ask about discounts you're not currently receiving. Common ones include bundling. Home plus auto can save 10 to 25%. Safe driver discounts, 15 to 25%. Low mileage discounts, if you drive under 7,500 miles annually. Professional or alumni association discounts and good credit discounts. Second, ask about policy restructuring. Increasing your deductible from $500 to $1,000 typically saves 15 to 25% on collision and comprehensive, but only do this if you have sufficient emergency savings to cover the higher deductible. Third, ask about usage-based insurance programs. These monitor your driving and can save 15 to 40% for safe drivers who don't mind the tracking. Script 3, the closer. Based on what we've discussed, can you tell me the best rate you can offer me today while keeping me as a customer? I'm making my decision this week. Creating a soft deadline moves the conversation toward action rather than indefinite consideration. Here's the truth. Sometimes the best negotiation is walking away entirely. According to the Insurance Information Institute, customer retention has dropped 5% since 2021, resulting in a 22% increase in policyholders switching carriers. Insurance companies are being forced to compete on price like never before. The math of switching. Get quotes from at least 5 insurers for identical coverage. According to MoneyGeek's 2025 analysis, rates for the same driver with the same coverage can vary by $1,248 to $8,520 annually between companies. That's not a typo. The spread is enormous. When comparing quotes, make sure coverage types and limits are exactly matched. Don't compare a $500 deductible quote to a $1,000 deductible quote without adjusting. Stay. If you've been with your insurer through an at-fault accident or claim and you're benefiting from accident forgiveness or a claims-free discount that restarts if you switch, you have significant bundling discounts that would cost more to replicate elsewhere. You've built loyalty credits or tenure-based discounts that represent real value. The rate increase after applying available discounts puts you within 10% of comparable quotes. Switch. If your insurer is among those with aggressive 2025 rate hikes. American Family, Allstate, Liberty, Mutual, and competitors are offering materially better rates. You've received comparable quotes that are 15% plus lower for identical coverage. Your driving profile has improved, cleaner record, lower mileage, better credit since you first enrolled, and a new insurer can re-rate you favorably. You're not mid-claim or expecting to file a claim in the near term. The switching process. Never cancel your existing policy until your new policy is active. Have your new policy start date coincide with your old policy's expiration to avoid gaps in coverage. Request refunds for any prepaid premiums on your old policy. Beyond negotiation and switching, there are structural moves that reduce your rates over time. Credit score impact. In almost every state, insurers use credit-based insurance scores to set rates. According to industry data, drivers with poor credit pay up to 88% more than those with excellent credit. If your credit has improved since you enrolled, getting requoted, either by your current insurer or a competitor, could yield significant savings. Coverage optimization. Review your coverage against your actual needs. If your vehicle is older and fully paid off, dropping collision and comprehensive might make sense if the vehicle's value is low relative to your premiums plus deductible. However, and this is important, don't reduce liability coverage to save money. The minimum limits required by most states are dangerously low. I always recommend at least 100/300/100 liability, plus uninsured/underinsured motorist coverage that matches your liability limits. Telematics programs, usage-based insurance programs like Progressive's Snapshot or State Farm's Drive Safe and Save track your driving behavior. Safe drivers, those who avoid hard braking, don't drive during high-risk hours, and maintain consistent speeds, can save 15 to 40%. The trade-off is privacy. These programs collect detailed data about where and how you drive. If you're comfortable with that and you're genuinely a safe driver, the savings can be substantial. Here's your action plan for the next 30 days. Week 1. Review your current policy in detail. Know your coverage limits, deductibles, and current discounts. Check your credit score, free through many banks or services like Credit Karma. Calculate your actual annual mileage. Week 2. Get quotes from at least 5 competitors for identical coverage. Use comparison sites, but also get direct quotes from companies like Geico, USAA, if eligible, Zurich Insurance, and State Farm. Document the best quotes with specific coverage details. Week 3. Call your current insurer's retention department using the scripts I provided. Reference your competitor quotes. Ask about every possible discount. Request a new quote based on any improved factors, credit, mileage, etc. Week 4. Make your decision based on total value, not just price. If switching, coordinate timing to avoid coverage gaps. If staying, confirm any negotiated changes in writing. Every 6 months. Reshop your insurance even if you're happy. Your rates and competitors' rates change constantly. This takes 2 hours and can save hundreds annually. Insurance companies count on inertia. They know most people will see a rate increase, feel annoyed, and do nothing. They've built their entire business model around this behavior. Don't be most people. The difference between accepting a rate hike and actively managing your insurance costs can be $500 to $1,500 per year, every year. Over a decade, that's a meaningful amount of money that stays in your pocket instead of padding an insurance company's profits. You can't control inflation. You can't control repair costs or weather patterns, but you can control whether you're getting the best rate available to someone with your profile and whether you're claiming every discount you've earned. That's strategic living. Subscribe so you don't miss it. Smart money. Strategic living. See you in the next one.